All right, so we'll be talking about financial awareness. So I think people know what a lot. I don't need to go through the details about my background. I do have two special needs family members. They're now in their 30s, but I always like to share that. So I've been through this myself, been through the schools and been through estate planning and so forth. So regional centers and all that good stuff. Uh, always put the disclaimer on it because it's not legal's particular advice. Everybody's factual situation is different, but it is, I think, some good general information that everybody should have. I'm not going to go through my outline here. We're going to be covering a lot of things, so I'm just going to kind of roar through this. So first of all, I say no fear. I think everybody's fear, and certainly it's my fear, is will there be enough money for my special needs son after I pass away? I have a 38-year-old, 39-year-old son now who has cerebral palsy, and he's pretty significantly delayed, although he can get around by himself. But he doesn't have a way to earn money, and so having enough money is a concern of mine. I say no fear, and part of this presentation is to alleviate fear. I do have to make a general comment that, I think we live in one of the best countries in the world, maybe not the best countries in the world. Our country does more for helping those that are disabled than in any other country in the world, except for a very few. Um, the purpose of this presentation is to talk about financial things you can do and take action. I'm going to give you a little action at the very end of this. I'm going to give you a 15, 20-minute action that you should do either tonight or tomorrow. So first of all, we need to transfer money to our disabled children. So how does that happen? We're going to be gone. How does our children have funds to survive on? Well, of course, I think most people here know that they've got to do some sort of estate planning. They need to set up a third-party special needs trust sometime. That doesn't mean you need to run out tomorrow and set that up, but sometime you're going to need to do that. And it's not inexpensive, but it's something that's very important. Again, something you don't have to run out now, but you should do some planning and thinking about it now. Funding that third-party trust, you need to be thinking about how you're going to put money into that third-party trust. Open and fund a Cal Able account now. It's a great, great way to put money away for your disabled family member. I'm going to go at length on the Able accounts. I just think it's just so important. One of the best benefits the government and the state of California has come up with ever. We're going to talk about life insurance. People need to know about life insurance, and then also beneficiary designations. That's just an important thing people need to know about when they're planning. So I have a whole hour presentation on estate planning and special needs trusts. So I'm going to skip over that very briefly, but certainly everybody should have a family trust. Generally, it's going to be a revocable family trust. A family trust is a legal entity to manage and distribute assets to avoid probate, and a well-written estate plan usually covers a whole slew of documents, trusts, wills, financial powers of attorney, advanced healthcare directive, all the various documents you need for not only when you pass away, but when the unexpected happens during your life. Third-party special needs trust, boy, oh boy, if you have a special needs individual family member, you need to have a third-party special needs trust. Um, it's a document where you put money into that document is irrevocable. Money can only be spent for that your special needs family individual. Really a powerful document. But it doesn't make sense to set up a third-party trust unless you fund that trust. You got to put money into it. And then how you put money into it, most people will have from their family trust have money go into their third-party trust upon passing. But there's other ways. Putting assets in the trust, putting houses in the trust. We'll talk about that. So how do you fund the trust? Now, what does the word funding means? Funding is our fancy legal word for just meaning you're putting your stuff, your money, your assets into this trust, this like what I call bucket, this trust. And the way very simple is if something has a title, you change the title to the name of the trust. Bank accounts, homes, that type of thing. For tax deferred assets, what we do is we name beneficiary designations for those assets. Um, Allocate to special needs trust. Um, direct assets to the family trust. I'm just talking about that. And again, the naming the special needs trust as a beneficiary. And so how do you spend money out of a special needs trust? It's a sole benefit rule, pretty broad. As long as the money is for that sole benefit, then it's a valid expenditure. It's important not to impact benefits, and that's a whole other topic that we'll probably talk about some other time. I want to talk about the time value of money, how important it is to start saving money early in life, because the time value of money over time grows exponentially and it is huge. I put together some old charts here. So if you were to start putting away just if you were 20 years old, probably most of the people in here are past that age, but if you start at age 20, putting $25 a week into some sort of financial account that earns a normal interest, by the time you reached 80, but that's about when people start passing away, there would be nearly $700,000 in that account. Now, most of you probably are older than that, but you can still start saving no matter what your age is. At age 50, if you started putting $25 every week into an investment account, you would have well over $100,000 by the time your life expectancy would go away. Now, what happens when you invest $100 a week? Probably at 20-year-old, or maybe even a 30-year-old, you couldn't afford to spend but $100 a week. But certainly, maybe when you're 40, 50, you certainly can. Look at that number. At 20, it's $2.7 million putting away $100 a week. Probably, like I said, most people can't do that. But what if you're 50? Yeah, and start putting $100 a week away in an investment account, you'd have over $400,000. I just want to illustrate this is such an important concept and just an important reason why to start saving early. So I get these questions: how much money do I leave for my loved one? And there's no simple or universal answer. The right amount depends on your child's unique needs, expected level of support, and so forth. Frankly, it's going to be hard for most of us, but to put enough money away to maintain the same lifestyle that they're having now. We want to make that close, maybe the same. We're all working hard to try and make that happen. For those that have lots of money, there are organizations that will do those kind of calculations for you and come up with some hard numbers.
Jeff,
Yes.
you have a clarification question regarding who owns the special needs trust and whether or not that's considered an asset and requires notification to SSI, EBT, Medi-Cal, etc.
Sure. So a third-party trust is owned by the trust maker. Okay, so it's going to be generally the parents who've created the trust. It could be grandparents or anybody else, but generally it's going to be the parents that create. They're the owners of that trust. Um, the important and one of the best advantages about a third-party trust is money in a third-party trust does not count towards any sort of benefits at all. Hugely important. There is a requirement that when a special needs trust is funded, meaning there's money actually in the trust, there's a requirement to notify Social Security and Medi-Cal. That's as simple as putting the document in an envelope, usually a next day air. There's not next day air, but somewhere where it's tracking it. Put it in an envelope, send it off to the agencies, and you'll never, assuming it's a properly run third-party trust, you'll never hear from them again. But the notification has nothing to do with an impact on benefits. The whole point of a third-party trust is there's no impact on benefits. Did I cover the entire question?
Yes.
Okay. So I want to spend some time talking about ABLE accounts because I think it's just a great way, and there's been significant changes here in the last couple of years that has really made it a great way to invest money for your disabled one. So there's ABLE accounts all over the country. Here in California, we have what we call the Cal Able account. Because of some special agreements with Cal Able and the federal government, it is by far the best way to invest money, and I'll explain that shortly. So, what is an Able account? So, back in 2014, so that's now 11 years ago, the federal government established Able accounts, and the thinking was all of us had ways to save money via Roth accounts or IRAs or 529 school accounts that type of thing. But there is no way for somebody who is disabled to save money. So the federal government actually was a product of the IRS, the Internal Revenue Service, set up ABLE accounts. They're tax advantage accounts, so you put money into it and it grows tax free. Over time, that makes a huge, huge impact. Um, uh, so there was some limitations. You had to be disabled prior to age 26. Now, for those of us that have developmentally disabled children, Downs and cerebral palsy and autism and so forth, that's not an issue. But it really was an unfair issue for a lot of other people with disabilities, car accidents or things that happened later in life, and they were not allowed to invest in the ABLE account. Starting January 1st of next year, the age goes from 26 to 46. So that's a huge thing. The big advantage, the big, huge advantage is money in an ABLE account does not count towards any of the various benefit programs. Now, expenditures might, but that's more of a discussion of the rules of SSI as opposed to an ABLE account. But again, I want to stress this. Money in the ABLE account grows tax-free, a huge advantage, plus money in the ABLE account does not count for benefits. Even more so, it can be what we call first party or third party. So in a third party trust, what that means is the individual, the beneficiary's money can't be in that third party trust. Usually for a lot of us, that doesn't matter because our developmentally disabled children aren't making all that much money anyway, so it doesn't really matter. However, for ABLE account, it can be first party or third party. There isn't strict rules on that. So if your son or daughter is making some money working at the grocery store or whatever, they can put money into that ABLE account also. Um, the big negative, the big negative is there's a payback provision in ABLE accounts. So the federal government put in a payback provision that said when that person passes away, the state Medicaid agencies is required to come in and take that money. It killed it as a savings program. Who is going to put a lot of money into it when there's the chance that the government's going to come in and take that all away? There's also a spending profile, which I'll get into, which is very advantaged. So I actually started an ABLE account for my son way back in 2017 or 18. I didn't keep much money in it. I use it as a spending vehicle and not as a savings vehicle. Um, the big thing that happened fairly recently, about 2 years ago, is Cal Able. There was a statute that came out based on an agreement between the federal government. So a California statute based on a formal agreement with the federal government said that there should be no Medi-Cal recovery for Cal Able accounts. So it only applies to Cal Able accounts, doesn't apply to private Able accounts, doesn't apply to other state Able accounts. That changed everything in my mind, and now it turned into a valuable savings program. So again, it's both a savings and a spending program. It changes every year. So this year you can put up to $19,000 in it. An individual can only have one account. Also, if there are earnings by that individual, that's on top of the $19,000. So that's a lot of money to sock away. Frankly, I'm not putting away anywhere close to $19,000. I'd like to, but I'm not. If it hits $100,000, then the SSI payments are suspended. So it probably doesn't make any sense to let that grow beyond $100,000. However, later in life, it's highly likely that your son or daughter who's on SSI is gonna graduate to SSDI. Then that $100,000 limit goes away. Again, the disability must have occurred prior to age 26. So that was really depressing for me to have to tell people they couldn't get an ABLE account. Next year it goes to $46. It's so easy. It's an online. These are online accounts, so you don't walk down to your local Bank of America and so forth. It's a state run. The state actually has a private organization running it for them. But it's all online. You do everything online. Easy to set up. You can do it in 15 minutes. I was actually in another state, Ohio, because Ohio was much farther ahead than California and set up their ABLE account. 2 years ago, when California set up their CalAble account, I opened up the CalAble account, transferred the money. Literally took me like 15 minutes. So it's easy to set up. I'm going to stress that. Easy to set up, 15 minutes. Maybe if you read everything, could maybe 20. Of course, it sets up the financial independence, and it's a great program. One of the interesting things about it, and I don't even understand why they did this, but it's a great benefit. So, as most of you know, where you were involved in getting SSI, there's a real strict rule that if housing is provided, they do a 1/3 reduction in the SSI amount. Money coming out of a ABLE account is will not re, for housing will not reduce the SSI amount. Why they did that, I don't know, but that's great. So if you pay money out of a third party trust or pay money out of your own pocket for housing for your disabled son or daughter, you get a 1/3. You have to report that, and there'd be a 1/3 reduction. If you launder money through a ABLE account, there's no reduction. Eligibility, I keep on harping on this. It's age 26 and it's 46 next year. Um, in order to qualify, how do you qualify for being on ABLE account? You have to be eligible. The law says eligible to receive SSI, SSDI. So you don't actually have to be receiving it, but as long as you're eligible for it, that's the wording in the law. Um, there's also what they call a condition of what's called list of compassionate allowable conditions. Under the website, they use CAL, C-A-L, CAL listed conditions. There's 287 conditions. Just about every medical thing you can possibly imagine is in that 287. Unfortunately, and this bugs me, as being serving on the board of the Temecula NAMI Association, National Association of Mental Illness. It does not include any psychiatric disorders, any mental illness. So somebody with bipolar, depression, anxiety won't qualify. Why they've done that just is annoying me, because those people have as much time, if not more, of a hard time finding work than anybody else. If somehow you can't qualify because you're not eligible to receive SSI and SSDI, which is hard, if somehow you don't have one of those 287 conditions, you can have a doctor say that your son is disabled, and that's called self-certification. So that'll qualify. Bottom line is, it's pretty easy to qualify for an ABLE account. The big thing has been the age, not the ability to qualify. Um, I'll talk about the $100,000 limit for SSI. Um, Wages, I said wages can't go in there, but wages are still something that needs to be reported to SSI. Like I said, it can be used for housing. We have some friends, some close friends, that they bought a condominium for their daughter. They're fairly affluent, so they bought a condominium and are paying the expenses, clearly paying for housing. So, and there was a 1/3 reduction in her SSI check. So what they started doing is they started running money through the ABLE account to pay for housing. Boom, her check went from, back up to the 1206 number. Um, Again, it doesn't impact Medi-Cal, SSI, or any other benefit for that matter. But the payback is a huge thing. But with CalAble, there's no payback. Other states and private organizations, there is. Yeah, just yesterday or 2 days ago, I had a financial advisor sent me a beautiful brochure about ABLE accounts, and they've set up this beautiful brochure. And what they're promoting is, instead of just putting the money into CalAble account where money is being taken out, they have a investor. The trouble is, there is there's the payback provision. Funds can be spent. I need to get quicker on this, but this is so important in an able account. Funds can be spent for that relates to a disability to maintain health, independence, quality of life, basically just about anything. Um, you can't spend it on alcohol or gambling. Um, um, it's it's uh, it's easy to put money in and easy to spend money. IRS has the right to audit expenses. They never have. I doubt they ever will. I just can't imagine the IRS would be going after relatively small dollar able accounts when there's so many bigger fish they could go after. Um, okay, the spending side is huge. So so what you get is a true link card. It's like a credit card. It's a debit card. So you move money from the able account to the debit card. And so if you have a relatively high functioning a family member like my son John, he likes to go out and spend money, go to the movies, he can actually buy things at restaurants. When he's going out with his group through a regional center, they go to McDonald's or these places, and he can use his debit card to spend money. He can be swindled easily. He doesn't really understand the value of money and so forth. So somebody can take him, which has happened in the past. As I have a long story, which I won't share with you, but we had a lot of issues with that before. He now has his TrueLink card. What's nice about it is I can control how much money's on the card. I can control how much money can be spent in a day. I can control how much can be spent at one location, the type of location. I have total control of the where it's spent at. Also, whenever he spends any money, I get an immediate text where he's spending money at. So we still have a lot of safety controls over that, but he's got the freedom to go out and spend money. I just think it's a wonderful tool. I encourage it. The CalAble website is a great website. Unlike most government websites, it's well written. It's easy to find information, easy to apply, easy to transfer money into it. So you can set it up so you can transfer money on a regular basis. An ACH transfer, open an account. It's only $25 to open an account. I've got it set up so I've got I think I forgot how much, $100 a month going automatically in to his Able account. Then he works in my office, and I have his work money, part of his work money going into that Able account. Easy to open, easy to deposit, easy to set up a recurring deposit. Okay, I think I beat Able accounts to death here, but it's really a great thing.
Jeff,
Retirement.
I'm sorry to interrupt you. You have a clarifying question regarding ABLE account eligibility, specifically if a doctor certified your child has disabling depression, does that mean they won't be qualified for an ABLE account?
From my understanding, that is not anything that would not qualify, unfortunately, and that irritates me to no end. Maybe the doctor can slightly reword it. Um, um, Anything else, Kristen? Any others?
Let's see. Is there another type of mental illness, or is there another type of account for those with mental illness?
Not that I know of. One of my frustrations in life here, one of the reasons I became a director on the board, our local board here, is we have all these tools set up here in California for those that are developmentally disabled, regional centers, and all these various benefits. But if you have a mental illness, a lot of those benefits goes away, and I just think it's wrong. And I'd certainly like to see some legislation that would change that. It's one of my big frustrations.
Thank you.
I want to talk about retirement accounts. This is a great way to save money. So you're part of a work program and there's a 401k, oftentimes there's matching programs. Take advantage of that. I mean, it really makes a big difference over time. I've just talked about the compound growth. So if you start putting money away, 3% of your salary, constantly putting money away over time, it's going to grow, especially if there's an employer match. I hear so many people who are not taking advantage of that. It's a great program to save money. Of course, start early from the time value of money. Um, there's another interesting um, thing about retirement accounts is under the Secure Act about 3 to 4 years ago now, when somebody left tax-deferred retirement accounts to somebody else, that used to be lifelong spreads. So they could take that money and take out over the span of their lifetime, thus reducing the amount of taxes they had to pay. Again, a 401 is like the opposite of an able, opposite of a Roth account. So you're putting money in, it's before tax. So the tax has to be paid when you take it out. So it made a big difference over a lifetime. You could stretch it out, have those payments lower. You stretch it out. Now they changed it to 10 years. Oftentimes, when the parents pass away in their 80s, the children are in their 40s, 50s, and their higher income years, and those can be higher taxed. If money that goes into, they made an exception, money going to a special needs individual or a special needs trust has a lifelong stretch out. So if you have some significant um, um, savings in a retirement 401k plan, you might want to have more of those funds go to the special needs trust, and then maybe other funds or other assets go into your other children's because of the stretch out. I kind of put about a $200,000 number, probably less than that doesn't make a whole lot of difference, but once you get over 200,000, it probably will make a big difference. Life insurance. Okay, Tom. I introduce Tom. Um, uh, I've always resisted buying life insurance until I was in my mid to late 60s, and I realized I need to move out on it. Trying to buy life insurance in your late 60s is a challenge. Tom was great, and he got me some great policies for my entire family. So, Tom, take it away. Give us some basics.
Jeff, thank you. I just have a few minutes to explain some very basic things about life insurance. So first of all, what is life insurance? It's a policy that allows you to make small payments over a long period of time into a contract that will pay a large benefit when you pass away. And that can benefit your family, your trust, etc. Of life insurance, what are the kinds of life insurance that are available? So the most common words that are used in life insurance and often misunderstood, term and whole life or permanent insurance. What is term insurance? Term insurance is temporary insurance. It's usually for a period of 10, 15, or 20 years. And after that, it goes away. So it's very likely not to be enforced when you pass away. Whole life insurance and other permanent types of insurance are guaranteed to be there when you do pass away. So it's the kind of insurance that you would use for the kind of planning that Mr. Nickerson does. You need to have life insurance that is guaranteed to be enforced when you actually do pass away. Otherwise, it does your special needs trust no good. Who are the parties to a life insurance policy? There's the owner who usually pays for the policy. The owner might or might not be the insured under the policy. Someone could own a life insurance on someone else, for example, but the insured is the person who would trigger the benefit when he or she passes away. The beneficiary of a life insurance policy would often be a spouse or a child. It could be a physical person, but it could also be a legal entity or a trust. For example, your special needs trust. And the special needs trust would be able to receive funds that could be used for the benefit of your disabled child, could be adult child, but because the funds are not owned by the child, they would not disqualify the special needs child from government benefits, which is a crucial part of the planning that Jeff Nickerson does. To buy a life insurance policy, how do you go about that? I think the most important thing is to work with a life insurance agent who understands you, somebody that you trust, because that person is working on your behalf to help you find the right kind of life insurance company, the right kind of policy, a policy that will be suitable for meeting your goals, if that might be funding a special needs trust, for example. And to get a life to buy a life insurance policy, you need to do an application. You need to be underwritten so that the insurance company will feel comfortable giving you a life insurance, selling you a life insurance policy have to be healthy enough. That might involve a medical exam, it might involve reviewing medical records, and sometimes a telephone interview. And it's important that you have a reliable, trustworthy person to help you through this process so that you're choosing the right kind of company and the right kind of policy. Couple other things, a whole life policy on a parent is a tried and true way to fund a special needs trust because it's guaranteed to be there to pay a benefit at the end of the parent's life, just when it's needed to benefit the child. The life insurance death benefit is income tax free, and that's especially important in funding a trust because trusts pay the highest income tax rates. So having a tax-free death benefit is an enormous advantage in funding your trust. And then just one word about long-term care. A long-term care policy is a special kind of life insurance policy that is designed to pay large benefits for non-medical care if it's needed during a person's lifetime. If you're the caregiver for a child, perhaps an adult child, and you become older and unable to care even for yourself, a long-term care insurance policy can provide extra money to have somebody come into the home and care for you as the parent. But if you buy the right kind of long-term care insurance policy, it could also provide money to care for your disabled family member, for your special needs family member, and care for the both of you. So just something to think about. If you have any questions about life insurance, feel free to call me or email me. Both of these are great ways to reach me. Thanks, Jeff.
Uh, Thank you so much, Tom. Let me just summarize real quickly. Know the difference between uh, uh, term. You'll probably outlive it, but maybe still good to have some term in case you, unlike like you die. It's got a 1% payout rate on the whole life. Start early. Two reasons. First of all, the earlier you start, the more money you're going to accumulate, and also better chance you're going to medically qualify. Again, Tom, thank you so much.
You're welcome.
So the other thing I want to hit on is maximize public benefits. I have a whole presentation I could spend probably 45 minutes talking about or more about public benefits. I've got them all listed here. Some of you may already have sat through some of my public benefits. Seems like when I'm talking to people, most people aren't taking advantage. They're missing out on something. So make sure you're maximizing all of those public benefits that are out there. I want to focus on SSI. Just about SSI is probably the most common benefit. It's also the one that most people can, that people, not most people, that people can easily mess up and get themselves in trouble on it. Okay, so it's a great benefit. This year it's $1,206 is the monthly amount. You should be receiving that if you're on SSI. If you're not, either they're taking a 1/3 reduction, which they shouldn't be doing. We can talk about that, or also because maybe there was an overpayment and they're taking money out for a payback. It's the most complicated. There's all these various rules. If you're working, you have to report the work, and there's only a 50% 50-cent reduction for every dollar of income. So the Social Security rewards that. For if you're handing money out to your special needs child, um, it's hard for them to find out, but there's a dollar for dollar reduction. If you're paying for housing, all these kind of things. But I can't, I've had some people say it's too I said a lot of people I heard, it's too complicated. I get all these letters and so forth, and it's only $1,200 a month. I'm just going to forgo it. Well, remember the time impact of money. And so if at 18 years old, if you decided not to take SSI for whatever reason, by the time that you reach 65, that would be a $1.5 million loss. I assumed a 5% inflation rate in both in the benefit increases on that. No, I think I used a 3% increase on the benefits for if you took that money and just invested it and didn't spend it, it comes to almost $3 million. Bottom line is time value of money. Take that SSI, use it right, and know and follow the rules. big thing is report earnings. It's really important. My son worked for me in my office. I paid him every month. I had a template check, a template letter that said, and all I had to do was, in May 2025, here in this amount of money, and that was all I did. I stapled his paychecks, sent it off to SSI, did that. They did their magic numbers, and then reduced the money. It's you can you, but you got to report that. So if money is coming in via working and the thing about working is they'll catch you because the IRS matches with Social Security, and they'll catch you. They're probably going to catch you 5 years downstream, and they just assume that here that same amount they'll go through and add penalties and so forth. It comes up to a huge number. So make sure you're reporting earnings income. Also important if there's an inheritance, grandparents leaving money to directly to a child. Somehow they find out about it, and that's a penalty also. Um, if that happens, if grandparents didn't set up a third-party trust, but they just gave Junior, who's on receiving SSI, a bunch of money, that's great. We can fix it. It's a lot more expensive. We have to set up a first-party trust and do a bunch of things, but you don't want to not report it. You want to do something about it. No one follow the rules. Read the mail. Oh my goodness, read the mail. I hate the mail from Medi-Cal and Social Security, especially Medi-Cal. You get these letters, you open it up and you go, holy mackerel, what are they trying to say in here? I have trouble reading these stupid letters, and I know I'm familiar with the business, but you got to open the mail and read it. And the big thing is, if they're going to stop your benefits, you must appeal. So what they'll do is they'll send you a letter and saying, if we don't hear from you by, and usually it's like several weeks out. So if you're not opening mail, you can have a time problem. Open the mail and they say, we're going to end your benefits on 1 month from now because you haven't given us this document. Immediately file an appeal, because if they file an appeal, then they have to continue the benefits until whatever is resolved is resolved. And it could be something minor. They need a document or so forth, but you want to keep those benefits going before you get sucked into the Social Security bureaucracy trying to solve a problem while the benefits are stopped. It's a lot more easier, mentally easier, if you're working a problem while those benefits are still going. I can't emphasize enough. Most people don't know about it. Um, I want to talk briefly about leaving your home to a special needs trust. I talked to a lot of family members who want to leave their home in a special needs trust, and that's fine. I'm doing the same thing. I'm trying to arrange something. I'm actually in the process of trying to find two homes on one lot that my wife and I can move to, and then my other son can live. And anyways, I'm doing the same thing. I want to leave a home for my son. Now, that being said, when you pass away, there may or may not be enough money to keep that home. Homes are expensive, as everybody knows. They need lots of maintenance. They have lots of expenses. They need lots of insurance, especially these days. And so you need to be thinking about homes and whether you want to do that. And if you do, be sure and give the trustees the flexibilities to sell that home if needed. I have a lot of clients that say, I want to leave the home in the special needs trust, and I want to put language in there, the home never can be sold. And we have a little conversation, and by the time we're through, I say, we got to have flexibility. There's a good chance that the home needs to be sold, either because you can't afford it, or maybe it just isn't the right fit. And also, putting a home into a special needs trust can cause issues with SSI and some of the other benefit programs. Also, it really complicates setting up a trust. So, are we going to have one of the parents will say, often the parents say, I'm going to leave the house to um, in the special needs trust, and the other child is going to care for him for the rest of their lives, and they can live there free. Oh yeah, really? Your other children need to have a life also. Maybe they may want to, and maybe they should be the trustee, but maybe not the caregiver. So it's some things to think about. Okay, finally, I want to talk about group homes. When I start talking, whenever somebody says a group home, they say, I never want my child to be in a group home," and that's okay. Um, I'm very involved in Special Olympics, a coach. We have a lot of group home people in group homes, and they're all very happy. They are living in very nice homes. They have the social interaction. So don't automatically assume a group home is a negative. I think there's a lot of positive aspects of group homes. Enough on that topic. Taxes, my favorite subject. Taxes, taxes, taxes. Everybody talks about taxes. So I want to cover four areas here. Estate taxes. Well, very few people have to worry about estate taxes. That was a big issue back in the late 90s and the early 2000s when the estate tax exemption was very low, meaning after a certain level, like $200,000, you had to pay these very high capital gains taxes that sometimes exceeded, 45%. Um, the current bill that was just passed by Congress a couple of days ago, they've kept the current limit. It's roughly $15 million. I suspect that most of you, including me, would like to have that problem to worry about, but most of us don't. So that's good news. Income taxes, um, there is no income that is there's no income on an inheritance. So you don't need to worry about that. But oftentimes people will, parents will pass away, the income will go into a trust, and then there's some growth, and then there's a tax filing that needs to be done. Maybe taxes have to be paid. A special needs trust, there are taxes that have to be, and trust taxes. So you want to make sure that you haven't funded it too soon, too much, to avoid taxes. Or if it's in a trust, you need to make sure that an expense, a payment out of that is a deduction from that income. So a proper or there could be investments in tax-free bonds. Again, I don't want to get complicated, but a special needs trust does need some management to ensure that you're minimizing income taxes. Okay, enough of that. Capital gains taxes. Okay, that's a big thing. Um, when somebody dies, there's a step up in basis. So if you bought a home, like I had one client back in a really nice area in Pasadena, bought a home in the late 50s for $15,000. Husband died in early 2000, worth 1.5 million. She needed to sell it, and anyways, um, uh, it matters a lot on how long you've held an asset and when somebody passes away and so forth. So sometimes that's a consideration of selling property is the capital gains. That's a very fact-specific situation on your situation. So, for a lot of people, there is generally a $500,000 exemption for capital gains. So something would have to go higher than that $500,000 to even kick off the taxes. But in some situations, there can be some very high capital gains taxes that you want to avoid, especially if you've got an asset that you've depreciated over its lifetime. You could find some very, very high capital gains taxes, something that should be managed. Most people don't understand the step up in basis. Property taxes here in California, it's a big deal. I think everybody who owns a home knows about property taxes, knows about Prop 13 and so forth. So the state has found every possible way to find a way to reassess that property. Putting your home into a revocable trust will not cause a change in property taxes. Putting it into a corporation probably will. Adding your son or daughter on it probably will. I get this question frequently. I'm just going to add my son and daughter to the deed of the trust. And I found this person down the street that'll do it for a nominal charge. You might not want to do that because you might see a dramatic increase in your property taxes. So be very careful about um, changing the deed on your taxes, on your property, to make sure you don't have a property tax issue.
Jeff, you have a question?
Okay.
It says if the disabled person doesn't have any family member who can help out when the parents pass away, does a fiduciary assist with selling the property or how can that be arranged?
Yeah, I'm a big fan of professional fiduciaries. So I frequently promote professional fiduciaries, and matter of fact, for special needs trust, I kind of almost insist. I don't really insist, but almost really push hard that name that professional fiduciary maybe as the third or fourth person in line. And so if the siblings who they normally name can't do it, don't want to do it, or have some medical issues or pass away and so forth, there's that backstop of a professional fiduciary, and they would handle all that. They're generally not caregivers, but they're going to manage money, and they're probably going to do a better job than your than your other children, unless they are professional money managers and really are familiar with how to manage money and so forth. All right. So this is my opportunity to share my opinions, to ramble a bit. Um, I have some thoughts on just good things to do to accumulate money. And this is not a holier than thou. Matter of fact, every one of these things I'm going to talk about, I did myself incorrectly. Vehicles. I am constantly stunned by all these people driving around these 70, $80,000 trucks. Oh my goodness. Why would you do that? Because I did it when I was 20 something. I went out and bought, this is back in 1980, so I didn't spend 70, $80,000, but I spent more than I should have. At that point, we had some young children, but I just felt like I needed to drive a truck, had that macho thing. Instead of spending all that money in a truck, I should have bought a reasonable vehicle and so forth. Car loans. Car loans are awful, especially on used vehicles. Oftentimes, the car loans are more valuable than the car itself. So especially with a used car, you want to be really careful about car loans. And if you can buy them used, I've taken the position several years ago that I haven't bought a used car forever. We always buy cars. I love CarMax. We buy a car that's 2 or 3 years old that has less than 50,000 miles on it, and it just worked out well. I always buy the guarantee, the program that repairs it. But and for the last couple of years, I've been able to buy it with cash. And instead of these car loans historically have very high interest rates, and frequently they're just bad things to have. Credit cards. Now I'm really going to get on my soapbox. I think credit cards are evil, just plain evil. The whole credit card industry, I think, is corrupt. The interest rates are usury. You'd probably get a better deal going to the mafia getting a loan than you would to these credit cards. And the credit card companies encourage you to spend money. You know, buy this, buy that, get more airline miles, get more hotel miles, and so forth, which are usually useless anyways, or have very little value. And then they have all this advertising, these financial institutions and so forth. I am not somebody who thinks the government should be involved in people's lives, but I certainly question these constant advertisements, constant mailings, and so forth of people to get credit cards, getting themselves in debt, and then it takes forever, and the worse the amount they get in debt, the payments get worse and worse. That was me many decades ago. I was managing my credit cards by seeing how much credit I had left. Dumb. Okay. Fortunately, I got out of that, paid everything off, and I do use credit cards. I only use a couple of them. I don't buy any of these airline points things. I used to. The airline miles are all that stuff just doesn't pay off. I use Sam's and a Costco card where I get real money back, and I make sure it's paid off, sometimes daily, weekly. I actually have money going in every week just to make sure that I never get it. It's always at zero. Um, uh, if somebody goes through bankruptcy, so they've gone to all that worry and tear and go through bankruptcy, and the bankruptcy is finally approved, guess what the first letters they get? Get from credit card companies. Here are some new credit cards you can start spending on and so forth. Because even though they've lost money on the bankruptcy, they're making so much darn money that they can send out new credit cards, knowing people will build up credit and know they can't file another bankruptcy for 7 years. Student loans. One of the worst ideas the government came up with. I remember the good old days before student loans or before they were, I'm that old, and going to college was actually reasonable. When I went to University of Long Beach, it was $95 a semester. Now, if it by inflation, it'd probably be like 300. Now it's, thousands and thousands. Student loans, the government by still handing out money to students, and I'm really encouraging them, forcing them to take these loans out, um, and and has well, all it's done is raise the cost of education. It's hard to avoid now. If I were the ruler of the world, I would ban credit cards, I'd ban student loans, and guess what? The cost of colleges would drop way, way down. Now, I did take out student loans to go to law school, um, but I also took out loans that were more than the college tuition. Shouldn't have done. Again, I'm not. This is not a holier than thou thing. I'm sharing some of my mistakes. It took me quite a few years to pay off those student loans. They're now gone. But anyways, just you may have to take a student loan for your son or daughter because that's the way things are these days. But I would try and keep it to the minimum. You don't need to go to a high expensive college. Um, the only thing a high expensive college gets is maybe your first job. That's it. Nobody cares after that. And then insurance, make sure you have enough coverage, um, all the various life, health, disability, liability. I had a client call me up and her son was driving her car and killed somebody. And the attorney that's defending the son from going to jail, said, "Oh, you'll lose your house. You'll lose your house because you're going to it's the 100,000 wasn't near enough." It's to go from 100,000 to 500,000 is not that additional money. You can buy an umbrella on top of that's $1 million umbrella. You have $1.5 million of coverage, and it's really not that much more than your low level liability coverage. Okay, that's enough preaching. I'm going to move on to some facts. Just to summarize, um, estate planning, we talked about that. It's important to have something set up. And I'm not suggesting that you run out and pay a lot of money right now for an estate plan, but just be thinking about it, what you want to do. If you can't afford a full-blown special needs trust and so forth, we can do a really inexpensive will that a list will allow the trustee to set up a special needs trust and set up guardianship and so forth for about 1/4 of the cost of a trust. So there's some less expensive ways to at least get started or just be thinking about it. Cal label accounts, this is a no-brainer. It's a tax advantage account, 19,000. It's a no-brainer. Maximize those retirement accounts. Life insurance, I think it's a great tool. It's not inexpensive. If you wait like me until you're in your 60s, it's going to be really expensive. But Tom has some great programs where you can start with a low amount and then add to it later on as you get older. Something to think about. And then make sure you're maximizing public benefits. Okay, a call to action. We're going to end this presentation with a call to action. Take action now. Everybody should start saving now. So how do you do that? Open up an account tomorrow, maybe tonight. Take you 20 minutes, $25 to open an account. Get it started. And then if you're going to put $25 in, set up an automatic ACH where $25 a week, $25 a month, whatever money you won't even miss is going into that ABLE account. Do it now. Now you've taken that first step in saving. Questions, comments, criticisms?
I appreciated the lecture. Okay. One question is, how do you go about going from SSI to SSDI?
Sure. So if the parents have paid into the SSDI system, and a lot of people have not. So if they're with the government, they probably haven't paid on into the SSDI system. But one of the benefits of the SSDI system, it's an insurance program. It's a government paid insurance program that if your child has been disabled prior to the age of 22, when the parents retire and start taking Social Security, then the your child will then be eligible to get SSDI, which is usually going to be about 50% of what you're getting for your no, it's roughly 50% of what you're getting for Social Security, more or less. But oftentimes the SSDI amount is substantially higher than the SSI in some cases if you had got a good work history. I'll use myself as an example. So my wife worked for Toyota and made a pretty decent income over the many years, paid into the SSDI system. She decided to take an early retirement. My son at that time, this is 4 or 5 years ago now, my son was receiving at that time about $800 in SSSI. When my wife retired, he immediately went off of SSI, went on to SSDI, and his monthly went from 800 to almost $1,500. And all the rules about reporting work and all the rules about one-third reductions and housing, all that went away. And even better, after 2 years he was on SSI, he now gets Medicare. So now he's on Medi-Cal, Medi. He gets both Medicare and Medi-Cal. So that's how you do it if you've been fortunate enough to pay into SSDI.
You got a great question here. Someone says, if I do $25 a month to the ABLE account, wouldn't the ABLE account fees eat up the balance?
Say that again. So
There's asking about the $25 a month transfer that you're recommending, and wouldn't the fees, the maintenance fees for the ABLE account, eat up that balance?
no, no.
It's
I think
they're
I
they're
forget what it is.
Yeah, they're quarterly, and if you opt into the going paperless for your statements, and it drops down even less. I think it's like, and it also depends on which fund you're invested into.
It's pretty minimal.
It's very minimal. But yeah, great question. Okay, let's see. You have somebody else asking, when my husband retired, they switched me from SSDI to disabled adult child. Should I stay with DAC or reapply for SSDI as they are asking me to do?
Well, usually SSDI is disabled. Is the disabled adult child. So it's usually the same program. So I'm a little confused by the program. Um, and there are various nuances. So I guess I really can't answer it. Certainly, certainly you want to do whatever's going to maximize the money. I mean, whatever's going to get you more money. That's what you want to do. It's the short answer. Sorry, I can't be more specific.
Okay. Someone was saying that they're paying $7.50 per quarter in fees for their Calable.
Mm.
Yeah, that sounds about right. It's pretty minimal. Someone says, wonderful info. Thank you very much. Are we allowed to use unearned income from IHSS to save for our child in an ABLE account?
Yeah, I don't see why not. You can put money, any money can go into an able account, can be wherever. So yeah, sure.
Yep. This question is there anything to do about credit card debt that is in collections?
Well, if you need to take a hard look at your credit card debt and your income. And nobody wants to go into bankruptcy, but on the other hand, bankruptcy isn't that bad, and it does wipe everything clean. And then you start over again. You just want to make sure that you change your habits. So I would take a hard look at that. And I'm not a person that says don't go into bankruptcy. If you've got just some impossible credit card debt that you're never going to be able to get out under, then I would recommend a bankruptcy.
Um, Someone said, I think this is a clarifying statement about the person that was talking about the disabled adult child. They're saying they keep asking me to apply for SSDI, but I agree that they are one and the same.
Okay.
Interesting.
Yeah. Yeah, it is odd. I'm certainly it's if you're on, yeah, okay, man, I can only speculate.
Let's see. Someone says, does your office offer payment plans for special needs trusts?
Yes, we do offer payment plans. We like to get half the price up front, but that's negotiable. And then we do a payment plan of $200 a month. And there's no interest rate. It's not reportable or anything. It's just a straight payment plan. So far, I haven't had anybody default on me on it, so that's kind of nice. But yeah, we have several people on payment plans and are happy to do it.
Okay. And then another question is, do you recommend able accounts versus a trust?
Yeah, so if somebody is debating whether to put money into an able account or a trust, you should have a trust in place. So when you pass away, there's a trust for money to go into. But sure, I would always recommend putting money into an able account first because of that tax-free advantage.
Do you have to be a homeowner to have a trust?
No, not at all. Um, no, you, we might. Um, we might do something different. We might do just a simple will and then set up a special needs trust that the will would f flow into. Just depending on the situation. And so we have a lot of people that, will that don't have that many assets at this point and don't have a lot of money. I get some, 20 somethings and they're here in my office that, have a couple of children and they don't have much money. And I say, you don't need to set up a trust right now. Why don't we do just a simple will at this point and that would create a special needs trust in the event you passed away, as long as everybody's healthy and so forth. Fortunately, the statistically of both of you passing away in your 20s is pretty darn low. So why don't we do something less expensive and then maybe downstream in later years we can set up a formalized trust-based estate plan. I'm happy to do that. I recommend it.
Another question is an able account still a good idea for a young adult with low support needs who may end up being able to support himself as he gets older? We aren't sure how independent he will actually be as he gets older.
Sure, why not? Absolutely. So we're going to see a lot of people with this change in the law from 26 to 46. We're going to see a lot of like victims and so forth that are fully competent that are going to be opening up able accounts. So absolutely, somebody doesn't need to be somebody does not need to have some incapacity issues to open up a able account. Absolutely.
Okay. All right, let me just review, make sure I haven't missed any questions, but I don't think I have. But does anyone have any questions for Tom regarding life insurance or long-term disability? Anything he mentioned in his presentation? Because I do believe he has to get going shortly. Um, Another question, is it okay to leave your bank account in the name of a trust? Someone says thank you to Tom.
Um, is it okay? Can you repeat the question?
Yes. Is it okay to leave your bank account in the trust to your kids? I'm assuming they mean in the name of the trust to
Yeah,
your
you
kids.
yeah, you should absolutely. I mean, you should either have the name of the bank account and the name of the trust, or name the trust as um, um, a beneficiary after the parents. So if it's so what do we tell people? If you have any significant accounts, yes, change the title to the name of the account. If you have any retirement accounts, name the trust as a secondary beneficiary. The spouses should name each other first. Name the trust, or the better yet, the special needs trust as the secondary. When it comes to your everyday checking and savings you use, we tell people don't even bother with that. We use what we call a pour over will. So those that pour over will pour over those assets into the trust. It's a hassle changing your everyday account if you got auto pay and Zelle and all that kind of stuff. So you don't need to move those.
Okay, and I see some people were asking questions about life insurance. Tom dropped his information in the comments because I think that that would probably be a better way to get a more robust explanation because it's really hard to summarize all that in a very short presentation. I really appreciate his effort to do so. Um, let's see. If a parent is on the younger side, do you have a ballpark for what the minimum net worth should be when beginning to set up a trust?
Um, well, I think my answer here is I can't really answer that directly, but I think you should be doing some planning, okay? And I'm kind of repeating back, if you don't have that many assets and you're fairly young and so forth, then maybe just a simple will is the way to go. But I've got people coming in my office that have got, a house and a rental property and a business and then, some multiple accounts. They obviously need a full-blown trust. If you're kind of in between there, that you've got a trust and so forth, what we're really concerned about is you passing away. And if you're both husband and wife are young and healthy, and they're probably not going to drop dead. But if you're in your 70s and 80s and you are ill health, then maybe it's a better idea to move forward. So it's kind of a gray area. I'm sorry, I really can't give a, a, a specific answer. But clearly, the more wealth they have, the better it is to get something set up sooner. And we can talk about, does it make sense to set up set up corporations and those kind of things? We can do those kind of topic if somebody has, a lot of assets.
Okay, and then a couple people were asking where they can locate the recordings from the previous presentations. Those are going to be posted to the Nickerson Law website, as will this one. I think given the time, we'll go ahead and wrap up. And I want to thank Tom for his time. I want to thank Jeff for his time. I'll go ahead and turn on my camera. All right. Let's see. Someone was asking about putting stocks in the trust. If you want to grab that one real quick.
Sure. So most people have stocks in an account like with Dean Witter or Charles Schwab or Fidelity, and so that's really simple. You just call them up, and they'll do all the paperwork for you. Now, if you actually own like real stock certificates, that's a bit of a more of a hassle. You got to actually talk to the company and so forth. But the vast majority of people that are with financial institutions, they'll even take care of the paperwork for you.
Yeah, I usually just send the certificate of trust to them, and they fill it out, and then you just have to do a updated paperwork every year or two. I think every 2 years is what's required for compliance. It's not too bad. Well, thank you so much for your time. Thank you once again for your generosity to Go Bananas and all of our families and sharing your expertise. I actually really enjoyed this presentation. So I know it's your first time putting it together, but based on the feedback in the chat, I think it was very successful. And I think it was definitely going to be one of our more popular ones that we'll definitely have to do again. So I think you'll both be getting some follow-ups with families based on the information you provided tonight. So, good evening to everybody. Enjoy your nights.
Let me just
Oh, go
also
ahead.
thank Kristen so much
Oh, thank you.
for arranging this, heading up Go Bananas. Go Bananas has turned into such a wonderful organization, and so many people the sharing information. And I know Kristen works very hard to make it a success, and she's the one who set these up, and she's the one that came up with this very presentation. So thank you, Kristen.
Oh, thank you. I appreciate that. It really is my pleasure. I really do enjoy making this available to everybody. So thank you for that. All right. Well, sweet dreams, everybody. Hopefully everyone can get to relax before the gauntlet of tomorrow, whatever that holds for you. And our next presentation, I put in the chat box, I believe it's July 23rd, but let me double check that. Um, July
22nd.
22nd.
The second, yeah.
Yeah, the 22nd. That's our final presentation where we're going to go over all of those public benefits that Jeff was kind of briefly going over. So that's a great one to, and that'll be our final of our series of 4. So good night to everybody. Thank you again for your time and take care.
All right.
Bye.